Hi, and welcome to the PRT Pod. I'm here today with Rosie Twist, Origination and Execution Director at L&G Institutional Retirement, and Laura Amin, Head of Pensions Consolidation and Partner at LCP. And today we're going to be talking about run-on, buyout, or both. Could I start with asking you to introduce yourselves, please?
Sure. I'm Rosie Twist, and as you said, Roshni, I'm an Origination and Execution Director here in our pension risk transfer team at L&G. That essentially means I'm a deal lead, so I see deals through from when we quote on them through to when they sign for buy-ins and buyouts. At L&G, I think we're really well placed to be a part of this discussion on run-on, buyout, both. We're clearly a long-standing insurer and have been in the buy-in, buyout market from the off. We're also one of the UK's largest asset managers, so we can support lots of schemes on their investment strategies.
Thanks. And Laura?
So I'm Laura Amin. I'm partner at LCP. I advise a number of clients on endgame strategy. At LCP, we're supporting our clients reflecting the latest in policy developments and market innovation, and we're really proud to have been at the forefront of discussions on surplus release and ongoing discussions in terms of what that looks like in practice with government. So it's a really exciting time to be in that role, and also to bring that into our discussions on a day-to-day basis with our clients on strategy and on run out or buyout or both or other potentially, as we'll go on to see throughout the conversation.
Thank you both for joining me today. We'll jump straight into it. Rosie, could you tell our listeners a bit about what run-on is and what buyout is?
Sure, Roshni. So run-on is essentially a scheme carrying on doing what it's doing at the moment. So a pension scheme, it sits under the pensions regime, it's backed by the sponsoring employer, and it pays its benefits and pensions to members. Buyout is where a scheme transfers all of its liabilities to an insurer. So the insurer becomes the one responsible for paying benefits directly to all the pension scheme members. And insurers sit under the insurance regime, which is quite different to the pensions regime. It has much more stringent capital and reserving requirements. Insurers also often choose to hold much more capital than the regulations require. Before a trustee buys out a pension scheme with an insurer, they have to purchase what's called a buy-in policy. And so in that instance, trustees kind of get the best of both worlds. They have the scheme still sitting under the pensions regime, backed by the sponsoring employer, but they hold this effectively an investment policy with the insurer, which is backed by the insurance regime. And the insurer pays the benefits to the trustees on a regular basis, but then the trustees still pay them to the members. So the members don't see any difference. And we found the last few years, buy-ins, buyouts have been getting increasingly popular in the market. Many more schemes have been able to afford them. And so there's lots of demands for buyout. Having said that, there's some upcoming changes to surplus extraction rules that give schemes good reason to run on that we'll touch on later. It's not a binary choice. This discussion's about run-on, buyout, or both. And in practice, I expect a lot of schemes will do a bit of both.
It's not a binary decision about run-on or buyout. It's far more nuanced than that. And it could be more constructively framed for a number of schemes around what are the appropriate timeframes to run on prior to insurance, or in what timeframes do you want to move to insurance. There are also other endgames in town, in a sense. So there are capital-backed journey planning options, which might support reaching a buy-in or buyout transaction over time. There's also the super fund regime, so pension consolidators, which may also be routes for schemes that are currently underfunded on buyout and which can meet the onboarding criteria, which have recently been somewhat loosened through the pension schemes bill. But what's important to take home from this is that TPR's endgame guidance encouraged trustees to look at kind of the realm or the breadth of endgame options in their discussions on endgame strategy. And that includes clearly run on, clearly buy in, buy out, but also looking at alternatives where appropriate. And so basically having a fully informed view of the options available before setting foot in terms of your kind of strategic endgame journey.
I think that sort of brings us nicely to the next question, which, Rosie, I'm going to direct your way. Why would pension schemes choose to buy out?
Well, Members and trustees can really benefit from that. And insurers sit under the insurance regime, which has very stringent capital requirements, which means that there's really strong security for members backing those pensions, but also we're able to offer a really good member experience offering, put a lot of resource and dedication behind that, which trustees can see as a real positive. There will be some sponsors who feel quite hurt by the past. The pension scheme has been quite a drain on resources. By buying out, they separate themselves from that and they can focus on their businesses and maybe think about corporate restructuring without that burden of a DB scheme there. But insurers also really benefit from economies of scale, and they've got the size to do a lot that other pension schemes might struggle to do, particularly the kind of small, mid-sized pension schemes. By having that scale, we can invest really well. We can tick the productive finance agenda in particular. We've got the scale and expertise to be able to do that. In terms of productive finance agenda and the investments, so when we get a premium in, typically at L&G anyway, about 20% to 50%, somewhere in that range of the assets are invested in direct investments. And we like to use that, yes, to match the liabilities like we need to, but also to really help the UK economy. So at L&G, we invested £1 billion in Cardiff city centre. There we were helping build 300 buy-to-rent homes, a bus station, hotels, those types of investments. We also recently invested £2 billion in affordable housing across the UK. And it's these types of investments that at L&G we can do. We have the intel we need to be able to do that. We have the expertise to be able to get the planning permissions, the whole lot in place. And pension schemes effectively benefit from that because that all filters into the premium and the price we're able to offer them.
I was going to say, so there's a wider, social impact of this where you can see it actually being, premiums actually being used in the community.
Yeah, definitely. But the security is really important, and we're hearing from lots of independent trustees and consultancies that whilst rules are looking like they might change are going to change in relation to surplus extraction, which does give good reason to run on more in future, a lot of schemes are still going to target buyout because it's seen as such positive for their members.
It's very situation and scheme specific, isn't it, in terms of that balance of the security of the existing covenant versus that of an insurer, but also balancing off the kind of potential benefit of the discretions, any uplift to members, etc., en route to a potential future buyout transactions. And for some schemes, that time frame will be effectively dictated by factors outside of their control, potentially in terms of kind of data and benefit preparations for buy-in. That might be a factor, or they might have a liquid assets, which is kind of, again, waiting for them to run off becomes part of the equation of setting the timeframes. But I think for what's really new, kind of in the sense of for the last few years, has been this open debate and discussion around comparing the kind of relative perspectives of the insurance regime and run-on and other solutions out there in the market, be that capital-backed journey plans or other capital solutions and or super funds, and looking at it through a much wider lens, which TPR is definitely encouraging trustees to do in the context of their recent endgame guidance in June, and the fact that now all schemes need to document in their statement of strategy kind of where they're going forward, and just having real clarity of direction, but with the flexibility to be able to change if things do shift course. So, for example, Rosie, you mentioned the kind of new DB surplus flexibilities that will come into effect in 27-28. That's kind of one of those examples of something that new comes in, and how do you reassess your plans potentially in light of that? And it might be that you continue on the same trajectory, you're still targeting buy-in, buy-out, but I think it's important to have sufficient flex in the system, as it were, or in your plan to be able to factor in these new and emerging developments and reconsider your direction, and to have the strength of conviction that actually the original path may well continue to be the right one, and that's fine, but it's that informed choice.
Great, thanks. And we'll touch a little bit on the sort of surplus release point a bit later on, but what have you been seeing, Laura, from an advisor perspective?
What is common, as I've referenced, is a need to understand up front what the various parties' objectives are, so from the sponsor's perspective and the trustee's perspective, and to kind of have an open discussion around what those are in order to then assess kind of the options against those objectives. There are also differing trustee views on kind of trustee duty with regards to whether that is to fully ensure members' benefits as per the rule entitlement at the point at which it becomes affordable to do so, or whether there is grounds for looking to potentially run on for a period beyond full buyout funding and secure additional benefits for members, kind of member uplifts effectively. So it all does come down to the specifics, but I think the core theme running throughout is that setting of your own objectives and then considering kind of how the various options sit against those. And importantly, actually, just taking a step back even from that point, and what I've been supporting a number of my clients with for many years now is that initial step of training. All of the kind of acronyms and the pensions jargon that just rolls off our tongues, we forget sometimes is just that, is jargon. And we've mentioned that there's new pension surplus flexibilities, there's super funds, there's other solutions out there. All of this is new, relatively new, I mean, for the pensions industry, very new, in terms of kind of solutions and options out there for trustees and for sponsors. And so having that initial training and understanding the realm of the kind of art of the possible, the realm of the options out there, is also a key part of this.
Yeah, that's fair. And I guess both of you sort of touched on the surplus flexibility. What do you think the impact of the pension schemes bill is going to be?
The draft bill provides for the minimum for surplus release on an ongoing basis to be set with respect to a low dependency funding target rather than buyout, which is the current kind of threshold or yardstick. It also enables or provides for trustees to overwrite scheme rules effectively, where previously they may not have made an amendment that enabled them to share surplus with the sponsor. It's also leading to sponsors and trustees looking to the future, because as I mentioned, this is a draft bill presently. We don't expect the kind of secondary legislation which enacts this until 27, 28, or potentially even 29. So there is some time before it comes into effect, but trustees and sponsors are having constructive discussions now around what that might mean for them in terms of might they reach some kind of form of agreement on surplus sharing? Will there be any surplus to share in those parameters? And actually, is running on beyond low dependency funding, beyond buyout funding, something that they are looking to do, which turns the question back round to kind of timeframes for run on, and whether actually they're looking to target insurance in that timeframe.
Great. And Rosie, what are you seeing from an insurer side?
I'm going to say so far, not a huge amount. The changes coming on surplus extraction have been known of in a broad sense for a couple of years now, from a consultation. Only recently is the pensions bill, I'm going to say, solidified or confirmed that this is happening. But as Laura said, some of the details are still to be, I guess, consulted upon and go through secondary legislation and the regulations. So there's still detail to come and a few more years to go. At L&G, we've been busy. A lot of schemes can afford to buy out now, and we're expecting volumes to continue at a similar level to what they have been the last few years, so maybe 40 to 50 billion a year across the market. We're seeing schemes approaching us at all sizes of the market, from the smaller ones, increasing numbers there, the larger ones are still coming. And that includes some mega schemes. We're also seeing very big schemes looking to purchase what are big transactions, but only a part of their scheme size, I guess, with us. So that'll be as part of their longer term strategy and journey plan. I suppose what I'm saying is schemes can choose to run on, and insurance can be a part of that through partial buy-ins. So we're seeing that happen too.
And how can schemes balance the benefits of running on versus the security of a buyout?
So we expect a number of schemes will still seek the security of a full buy-in in order to crystallise that surplus before they then enhance member benefits or let the employer use some of it, because then they'll be safe in the knowledge that those core member benefits are protected and the surplus can be used as they wish. For others, I suspect that the buy-ins will be pushed down the line and they'll have a period of time where they seek to extract surpluses more regularly, still lock down their risks very carefully through their investment strategy, but have a longer term plan in order to make the most of the new rules.
And I guess just to add to that concept of insurance alongside run-on definitely can work in the context of, say, a partial buy-in or a buy-in of a certain, or potentially sequential buy-ins of the scheme. I guess the group of schemes for whom a full buy-in and running on in combination works is obviously far smaller, because you're requiring that quite chunky surplus in order to make that work from an economic point of view of kind of earning returns on that. But that's not to say it doesn't happen. I do have one scheme myself where it's in that position, and actually that surplus in that scenario is being put to productive use in the sense of funding DC contributions, which are in the same trust for the sponsor, and also ongoing accrual, given that around 2% of the benefits are not quite yet insured because they're in respect of active members. So perhaps that goes to show just how kind of, again, I sound like a broken record, but how nuanced and kind of scheme specific these discussions and debates are. But they do have those common threads of looking at through the lens of security, through the lens of potential upside returns versus risk, through the lens of what does it mean from the members from an admin point of view and member experience point of view. And often the ESG and RI kind of responsible investment factors come into play.
Great. Thanks both. Those were all the questions I had for you guys today. Are there any final thoughts you'd like to share with our listeners today?
I'd like to remind our listeners that we can serve the whole pensions market, whatever a scheme's long-term plan is. We can definitely help on the asset management side, put strategies together to help you lock down risk and invest like an insurer. And clearly we're there for the buy-ins and buyouts too. But going further than that, Laura was speaking earlier about how a number of trustees have been using DB surpluses to fund DC contributions, where DC schemes sit within the same trust as the DB scheme. We've recently facilitated a similar solution for a scheme, but where the DC scheme wasn't within the same trust. So we've enabled the transfer of surplus from a DB scheme into our DC master trust, which can then be invested as its own pool of money and then used as contributions for members as an employer sees fit in future. So that's an example of one innovation that's in the market now that is building on these changes to surplus extraction rules. I'm sure there will be more. Watch this space. There's lots going on.
Great, thanks. And Laura?
I think I'd reiterate some of the key messages throughout our discussion today. So every scheme is unique and there's no one-size-fits-all answer. And so the right strategy is going to very much depend on the specifics of the scheme, the specifics of the trustees and the sponsors' objectives, and risk tolerances and attitudes to risk. So in my view, setting a strategic plan which best meets those kind of differing perspectives and objectives is important, but having sufficient flex in that plan to be able to take advantage of opportunities as and when they might arise, as Rosie alluded to in terms of kind of the recent regulatory developments on DB surplus. So effectively having a conviction in your path, but having the flexibility to be able to flex that with due reason or cause.
Great, thanks. And thank you both for being here once again. And thank you for listening in. I'm Roshni Sakaria, and this is the PRT Pod.